Hello and welcome to your weekly technical update, your guide to the charts that matter this week. I'm Andrew Gagan. Let's begin with analysis of Cochlear, with many brokers having recently downgraded their ratings on the healthcare stock. David Novak from Wealthwise Education says just looking at the trend will tell you it's not a buy right now.
Up the chart. Now that's a weekly trend. You can see it was going pretty volatile there between 2020 and 2023, and then it had a breakout to the highs, and it made what I could see there in late 2023, early 24, a double top, what we call a double top pattern, technically, and then it fell, and then it rallied, and then it's got a lower peak there, fell again to make a lower trough, and then it's also got a slightly lower peak now, and this is, like I said, this is the big picture on the weekly. So it's really struggling up here. I mean, I do not want to see this stock. If you do, it's at best a hold. If it does break that previous low that you can see there, which is around $250, that would be and that where that blue line is as well, going across, that would be your stop loss where you'd sell. But right now, at best, it's a hold. Great business, really great business, but the trend is not your friend. And if you look at the daily chart, which I don't have there, again, that's, looking at its weakness. Today it's down nearly 2%. So, the whole healthcare sector has been pretty weak, especially CSL. So it's not a sector right now that's, that's in favour from a sentiment point of view, which is what we measure when you look at charts. You're looking at sentiment, whether it's bullish or bearish.
Well, elsewhere in the healthcare space, we take a look at Ramsay Healthcare. David Novak says it probably looks appealing on the chart, but from a fundamental point of view, not so. He's more likely to keep it on his watch list.
The weekly chart going way back to 2011. You can see from 2011 to 2015, 16, like really strong trend. And I've again got the two moving averages on there, the 20-week and the 50-week and the blue moving average. And you can see it crossed down and went up, and it was going sideways like nowhere from 2015 to 2022. And then it's broken down in 23, and you can see the red moving, the 20-week moving average crossing below the blue, and it's remained below the blue. The only bright light here that I can see, again, looking at that indicator down the bottom, which is the relative strength index, it is showing what we call technically a bullish divergence. In other words, it's saying that down here, it looks like there's some buying, some strength coming in. That's what that indicator is saying. It's not saying rush out and buy it, but it's just saying that does appear, that indicator is showing there is some buying strength here. And the stock has come, as clearly it's come down a lot. So it's trading on a low multiple, about 20 times. There's about 14 brokers have a price target of at least 10% higher, $36. But I wouldn't be rushing to buy it right now. You've got to wait and look at the signs of, this. I'm looking at the daily chart here. There was a big sell-off in August when they reported, massive sell-off. So obviously there's a disappointment from the market. But I'm looking at the volume, which is one of the things you look at, and I'm looking at the daily volume since August, and it's really tepid. There's no commitment from the buyers or the sellers here. The only shining light is, like I said, that indicator down the bottom, saying there could be some buying interest come in here, but it's certainly a wait and watch. It's not a buy yet, technically, on a weekly or daily or even monthly.
Well, gold has proved to be irresistible this year, with more and more investors, as well as central banks, buying the precious metal, sending it to record levels. Violetta Todorova from Leverage Shares says there's no sign of immediate reversal, but it's worth being aware of some Fibonacci clusters suggesting some resistance emerging.
Not expecting a very strong pullback in gold. The maximum downside that I could potentially see, it's around 3,800, but it is quite unlikely for gold to retrace to that level. I believe in 2026, until the first half of the year, gold could easily trade to around $4,500 an ounce, and by the end of 2026, potentially to around $4,900. So the party is not over. The macro backdrop, the tailwinds are there. There is very strong central bank demand, and with all the geopolitical risks which are forcing investors to fly to safety, this appetite for gold is going to continue. However, if we look at gold miners, which I suggested last month that they're going to outperform the price of gold, if we see a pullback in equity markets, I believe gold miners will pull back with the general market while gold could continue to outperform. And once we see the pullback into the stock market over, gold miners will gather momentum and will try to catch up speed with gold again.
And that's it for this week's edition of The Charts to Watch. Join us for more technical talk next week. Happy trading.